Hello and welcome. So the turbulence we saw in September has continued largely into October, with even greater market volatility, domestic political drama, and economic uncertainty. In recent weeks, we've seen large interest rates hike by major central banks globally, a new UK Prime Minister, and a mini budget in name only that triggered dramatic movements in the UK gilts or government bond market. It's rare to see politics impacting markets as much as it has recently in the domestic economy. And it's difficult to keep pace with the news flow, and we actually apologize if the information I present here is already out of date by the time this video is released. However, with Chancellor Kwasi Kwarteng being removed from office and the arrival of Jeremy Hunt, the politics of aggressive tax cutting is being quickly reversed and actually just dismantled. Regardless of what else might happen in the coming days on the political front, the policies that triggered such a sharp reaction in the wake of the mini-budget will probably now remain off the agenda for an extended period of time. This level of almost unprecedented uncertainty, and we're talking about a chancellor presenting probably the most aggressive tax cuts of the last 40 years, and yet himself removed from office after just 38 days, has rendered the gilt market extremely volatile as well as challenging to navigate. From our perspective, the ability of the former chancellor to effectively put in place such an ambitious policy was met with disbelief by many, knowing how it would impact the country in the long term. We refrained from shifting our exposure in fixed income and foreign currencies as the damage was already done, and waited to see how viable it was to implement these policies. The policies have now been abandoned, but a high level of uncertainty somehow remains. So with such a high policy uncertainty, movements in long-term gilts were almost unprecedented, and it was both up and down, making it even more hazardous to trade during this period. However, given so much uncertainty and with the gilt market so volatile, investors can easily be caught on the wrong side of the trade, and we on our side have maintained an underweight to government bonds for some time, which has protected portfolios from the worst of the falls this year, and so we've retained that overall position with the aim of waiting for further clarity in order to reassess our position. On the macroeconomic front, the main highlight of the month so far was the release of US inflation data, so the Consumer Price Index, the CPI, on the 13th of October. This data is scrutinized more than ever by the market participants who are looking for clearer indication of the future path of interest rate policy in the US. The number came in slightly higher than the consensus at 0.4% month-on-month versus an expected 0.2%. The core inflation number, so removing the volatile energy and food components, also came in higher than expected, delaying any hope to see the Federal Reserve pausing its rate hiking programs in the coming weeks. And with all this news, it's quite easy to lose track and miss the fact that we are now actually entering the earnings seasons in the US and in Europe. Most companies are expected to report before the month's end, with company results scrutinized by all market participants. And numbers for the second quarter released in July were ultimately more robust than what many had anticipated and helped trigger a strong rebound in equities. US markets rallied 10 to 15% at the time. The consensus for the third quarter has seen earnings largely revised downward, and if US corporates show some resilience in earnings, it could have a meaningful impact on the equity markets. Overall, the near-term outlook globally remains subject to volatility for both bonds and equities, with major central banks likely to increase interest rates sharply in the coming weeks. Economic growth is likely as well to remain challenging, but let's not forget that much of this is already priced in by market, and a better insight into the health of big corporates and their earnings and how inflation will go will be key in determining the direction of major markets and asset classes in the coming period. Thank you very much for listening.